Is the current stock market overly concentrated at the moment? Too concentrated in the Magnificent Seven and too concentrated in the tech sector? And is the market, as a result, destined to experience a major decline? Those are questions we're going to talk about today because, as of today, the US tech sector accounts for more than 30% of the S&P 500, more than the second and third largest sectors combined, which are healthcare and financials, by the way. And arguably, the true weight of the technology sector is much higher, above 40%, and we'll get to that in just a second. So without further ado, let's get started. All right, I recently read an article by Goldman Sachs, and in it, 3 charts were shown that were highlighting the general level of concentration of the index at the moment. So before we take a closer look at the technology sector specifically, let's take a look at those charts. So what this chart here shows is something I have addressed in previous videos of mine, the largest companies of the index. And those are, of course, also the Magnificent Seven stocks. So the Amazons, the Alphabets, the Metas, the Nvidias, and so on and so forth. Well, they have massively contributed to the performance of the overall index in the most recent history. So basically, in light blue, you see the performance of the 10 largest stocks in any given year of the index compared to the rest of the index, highlighted in dark blue. And I guess there's not really much to add here, so let's take a look at another chart. And this chart here, you see the market cap of the largest stock of the index relative to the 75th percentile stock. And the largest company in the S&P 500 right now is Microsoft, which has actually overtaken Apple earlier this year, mainly driven by the great performance of Microsoft and at the same time the somewhat poor result or performance of Apple. And Microsoft is actually huge right now. The stock is trading at a market capitalization of around 3 trillion. And as a result, Microsoft actually makes up around 7% of the overall S&P 500. And just to give you some more context here, other large companies in the S&P 500 are Apple with a market capitalization of 2.8 trillion. Then you've got Nvidia with a market capitalization north of 2 trillion and Amazon, Alphabet, and Meta. Well, they also post market capitalizations above 1 trillion. But just to get back to the chart here, so basically Microsoft right now is more than 700 times larger than the 75th percentile stock. And then finally, the last chart from the Goldman Sachs article, and I'll make sure to link it in the description down below. Well, this chart here is more focused on the current valuation of the S&P 500, and more specifically, it's comparing the valuation of the 10 largest stocks in the S&P 500, the ones we just talked about, compared to the other 490 remaining companies. And clearly, the top 10 companies are trading at a higher PE ratio than the rest. So the top 10 stocks trade at a PE of around 25, while the other stocks trade at a multiple below 20. Okay, with that out of the way, let's focus on the tech sector specifically. So I've already said in the introduction of the video that the tech sector of the S&P 500 right now represents around 30% of the index. And that 30% figure actually understates the true weighting of tech companies in the S&P, because many companies that have a very strong tech focus are actually classified as companies operating in different sectors. For example, Google and Meta both are classified as communication service companies. And we've just highlighted that both companies also post a market capitalization in the trillions. So if you would add the weighting of these two companies, which should be around 2.5% and 4%, well, the true weighting of the tech focused companies in the S&P 500 will already be much higher and approaching the 40% mark. Now, 2 other companies that are among the 10 largest companies in the US, Amazon and Tesla, well, arguably these companies are also strongly tech focused. However, they are classified as consumer discretionary stocks in the case of Amazon. And if I'm not mistaken, I think Tesla is actually also classified as a consumer discretionary stock, if I'm not mistaken, as a, well, quote unquote, car company. I know Tesla shareholders don't like it if people say that. If we now take a look at the S&P 500 Information Technology Index, which basically consists of all the companies in the S&P 500 that are classified as, well, IT companies. Well, that index is up 13% year to date and up 50% over the last 12 months. Now, the question is this a problem? Is the high concentration of the Magnificent Seven, of the top 10 names, and the tech sector as a whole a problem for investors going forward? Of course, obviously, elevated valuations will lead to worse returns going forward? Well, I have a couple of thoughts on this question, but let me start by this. I think whether it is a problem depends. It depends on whether the weighting of the tech companies in the S&P 500 is mainly driven by an expansion of the valuation they are trading at, or whether the weighting is a result of great business performance. And what I might bring up in this context here is the performance of the Nasdaq index compared to the S&P 500 over the long term. And as we know, over the long term, business performance is all that matters. And clearly, the Nasdaq has performed much, much better than the S&P over more than a decade. So arguably, it's not really a problem as long as the quote-unquote tech companies are also performing as a group very well on a fundamental operational level, of course. And what actually inspired me to do this video is a chart that I came across on Twitter, and I'll just show it to you on screen right now. Basically what it is showing is that some level of concentration is completely normal. So what you can see here is the share of the largest sector in the US relative to the index. I'm not entirely sure whether the methodology here looked at the S&P 500, but it doesn't really matter. Of course, the overall point is that at any point in time, the largest sector in the US represented a significant percentage of the overall index. So in the more recent history, it has been tech. In the past, it has also been energy materials, which at some point also eclipsed the 40% mark. In the late 19th century and the early 20th century, it was actually the transportation sector. And if we go way back to the early 19th century, it was the finance and real estate sector. So again, concentration is completely normal. And let me just highlight another anecdote or an example that I came across on Twitter the other day, which I found quite fascinating. Well, basically, it was assumed that if you bought Amazon at its IPO and you sized that position so that the Amazon stake represented 4% of your overall performance, and you then invested your remaining money into the S&P 500, so the remaining 96% of your portfolio would be allocated to that index. Well, guess what? In 2021, if you would have just sat there and did absolutely nothing, well then Amazon, because of the spectacular business and stock performance, would now represent a weighting of, I think if I remember correctly, 90% of your overall performance. So some people would be worried about this, but if you think about it, well, that weighting of Amazon was only driven by the great stock performance, which you as a shareholder, as an investor, obviously are rooting for, that you are enjoying. That's the ultimate goal. So concentration per se is actually not a problem. And if your initial position wasn't extremely large, level of concentration may actually be an indicator of success in the world of investing. All right, if we go back to the Goldman Sachs charts, which were mainly focused on the 10 largest companies in the index, well, this also reminded me of a talk that Terry Smith recently gave, in which he addressed, well, the recent performance of the Magnificent Seven and the performance he expects going forward. And he is actually a bit skeptical about the performance. Let me just show you the clip real quick.
The Magnificent Seven. I like movies a lot. I'm very keen on movies. And I think you can learn a lot from movies. One of the things that I think you learn if you watch enough of them is there's no such thing as a new movie plot. Everything's been done before, basically. It all gets rerun. And the Magnificent Seven, which they've used as this term for these 7 stocks, which drove the market performance last year. The Magnificent 7 stocks, we've seen this movie before. In 7th of April 2000, Goldman Sachs named their Super 7. I'm guessing that they maybe had somebody who liked Lotus or Caterham cars on the staff at the time for Super 7. And here they are: First Data, Oracle, Teradyne, PMC, EMC Squared, Cisco and Dell. Those were the Magnificent 7 of 2000. How did they do? There you go. There's the next 5 years performance there, and there's the next 10 years performance there, basically. There's a great saying: history doesn't repeat itself, but it rhymes. Right? And I think we may find that if we had, on your behalf, entered into a full-blown Let's Own the Magnificent Seven last year, we might eventually be into watching the sequel to it and with the same outcome.
All right, so what Terry Smith here is highlighting, and I want to be crystal clear here, he's highlighting that elevated valuations will lead to worse results going forward in the world of stocks. And I couldn't agree more with him here. However, where I would disagree is, if I make an investment, I'm generally not making a bet on a basket of stocks. So I'm not investing in the Magnificent Seven as a group, as a whole. No, I would pick individual stocks, maybe within the Magnificent Seven, but also within the broader investing universe. So we have more than 500 companies in the S&P 500. I think we have around 3,000 companies in the US, and we have around 60,000 companies worldwide to choose from. And whether a specific group or a specific sector of that overall universe is overvalued, well, that doesn't really matter to me. That's not the game I'm playing. All I care about is finding 1 or 2, maybe 3 companies a year that are trading at attractive valuations, that are promising great returns going forward, well, if I can do that, I'm happy. That's all I need. And if the Magnificent 7 stocks are overvalued, well, I don't care. Then it's not my hunting ground at the moment. All right, that's it for today. I hope this video and my thinking helped you a little bit progress as an investor. If you want to learn more about my philosophy, check out my mentoring program in the description box down below. And with that being said, take care.